Remember I told you the 2.5 million seniors that get rid of their policies every year? Last year, nationwide, 2,699 sold. It's a really, really big gap. And a lot of it is advisors, both insurance and financial, either don't know about it, aren't comfortable with it, have misperceptions about it, and they're not talking to their clients.
Welcome to another episode of the Simply Retirement Podcast. I am your host, Eric Blake, practicing retirement planner for over 25 years, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. On today's episode, we're going to be talking about life insurance settlements, what they are, why they're often misunderstood or overlooked, why this conversation matters, especially for women who may be navigating retirement, widowhood, or other major life transitions. I'm going to be joined by Lisa Rehburg, president of Rehburg Life Insurance Settlements. Lisa works closely with financial, insurance, legal, and nonprofit professionals to help their clients benefit from unwanted or unneeded life insurance policies. She focuses on raising awareness of life insurance settlements as an option where appropriate, so clients don't unknowingly walk away from policies with little or nothing. And I just want to share a bit of context as well. As I mentioned to Lisa in preparation for our conversation, I recently posted a poll in the Simply Retirement Community Facebook group asking about interest in this topic, and the response was overwhelmingly positive. So there's clearly a lot of interest and a lot of questions around this, and I'm looking forward to this conversation. And with that, Lisa, welcome to the Simply Retirement Podcast.
Thank you for allowing me to be here. Delighted.
So, one of the questions I hear quite a bit when starting to help someone build a retirement plan is, do I still need life insurance in retirement? And of course, the general answer is always, well, it depends. You likely don't need it for the same reasons that you may have during your working years. It could be replacing lost income or bridging the gap for one spouse from those working years to retirement. But that said, life insurance can still play a role for, it could be estate planning, it could be liquidity needs. But you bring a very different perspective on how life insurance can be utilized in retirement. Before we get to that, though, I would love for you just to share a little bit about your background and what actually led you to the work that you're doing today.
I have been in the insurance industry for, let's just say, decades, 35 years.
Well, I say over 25 years myself. So just as there's nothing wrong with saying.
I pinpointed that, didn't I? I've been working with advisors, insurance agents, financial advisors, all that time. And I was in corporate for a long time. And about 10 years ago, it was time for me to not be in an airport every week. And so, right. Yeah. Lifetime platinum with Marriott for a reason. But it was time for me to not do that. And so I left my corporate job and stopped and said, what do I love to do? And I love to work with advisors and their clients. It's a passion of mine. But I wanted to do something different, right? That many people don't know about that can be of benefit for clients. Found life settlements, took about a year to research them, and we can talk about, all the regulations that are in place, but that was important for me, that it's transparent, it's regulated, it's legal, of course, all that, getting, relationships in place, and then launched my company. So I fell in love with them because they're unknown. They can benefit clients significantly. And let's be realistic, our country is aging and more seniors, right, are turning 65 every day. And so this solution is even more important moving in the future.
Well, so let's start there. So you share that millions of seniors walk away from these life insurance policies every single year. Can you just share why you feel like that happens? What's your perspective on what's happening there?
Yeah, it's really simple. They walk away, by the way, from about $100 billion of benefits every year. And it's very simple. They don't want them anymore, the policies, they don't need them anymore, or they become unaffordable. In other words, they don't fit in a retirement budget anymore. Or I hear all the time where people say, I just never thought I'd live this long. And they have those universal life policies that have imploded. The cash value has depleted, right? They have to put more money into the policy to keep it going. And they either don't want to or can't.
I would love to, just so, again, we kind of set the stage. Can you talk about what exactly a life insurance settlement is, just so we can be clear with that for anybody maybe hearing that term for the first time?
Good question. So it's a life insurance settlement, or life settlement for short.
Okay.
It's just a financial transaction. I parallel it to selling a car. When you sell a car, it's an asset that you own, right? So is a life insurance policy. Any policy, by the way, including term policies. But when you sell your car, you get a lump sum of cash. You sign the pink slip of your car over to the buyer. The buyer drives away with it. It's really similar. The client receives a lump sum of cash. They sign the pink slip of their life insurance policy, the ownership, right? They change the ownership over to the buyer. The buyer basically drives away with the policy. They're going to make those premium payments, and they're making themselves the beneficiary. So for them, it is an investment. And that's part of the reason why, well, that's all the reason why they're doing it, but that's part of the reason why for some people, they'll offer more money than for others. So we can get into that later, but it's a lump sum of cash, for a life insurance policy.
Perfect. Well, and you kind of touched on this as you were kind of talking about your background. So I think it's important to address here as well, because I'm sure, as you know, and I hear the similar things. The first question somebody's going to ask is this actually legal? Can you talk about that directly? Make sure we again outline the legality of this strategy.
Absolutely. It's been legal since 1911. There's a Supreme Court decision called Grigsby versus Russell. And in this Supreme Court decision, Justice Oliver Wendell Holmes deemed a life insurance policy an asset that you own. And as an asset, you can transfer ownership of that asset to anybody you want, anytime you want. But to be transparent, nothing happens until really the mid 80s. And that's when the market starts with the AIDS epidemic and viaticals.
Now, again, coming back to a few of the things you've already talked about, I think that's one of the things that I think confuses people a lot when you think about, what actually changes with the policy, because these are contracts, of course. So when you're thinking about, who becomes the beneficiary, who's paying the premiums, I think that's one of those that really catches people by surprise a little bit. But just the logistics of how this transition occurs, can you talk through that a little bit?
In terms of the whole process, or just how the transition itself occurs from the change of ownership perspective?
From the change of ownership perspective. Yeah. And again, who's making premiums? Once the ownership change occurs, who's making premiums? Who's now the beneficiary? Those little smaller details.
We go into escrow just like a house. We parallel real estate pretty strongly. So at the end of the day, once a sale contract is signed, we're in escrow. Every insurance company has a change of ownership form and a change of beneficiary form. I can change the ownership of my life insurance policy to anyone I want. I can change it to you today, right? It's just a change of ownership form that I sign, and the insurance company will change the ownership over to you. Just don't tell my husband. But it happens every day. This is not anything unusual. It has nothing to do with our market. It's just the course of regular business for insurance companies. And changes of ownership, changes of beneficiary are the same way. I can change my beneficiary to you today just by signing a change of beneficiary form. So back to your question, once escrow opens, the escrow company will send in the change of ownership form, changing the ownership from whoever owns the client's life insurance policy. And it may be the client, could be the client's spouse, could be a trust, could be whatever, but whoever, whatever owns that policy, that change of ownership form will change the ownership of the policy from the client's owner, right, to the buyer. And at the same time, the change of beneficiary will go in doing exactly the same thing, changing it from the client's beneficiary to the buyer. Once that's done, once the change of ownership and change of beneficiary have been completed by the insurance company, the transaction will end, meaning that escrow will close. And within the day or two, the client will receive their money. I'm not telling you it takes a day or two to do this whole transaction, but what I am saying, right, is once that change of ownership and change of beneficiary is done, escrow closes in a day or two, clients have money.
So one of the things I'm curious about, and just again, have not had a huge amount of experience with it, but when you take out a life insurance policy, there's this term called insurable interest. Like who can take out insurance on who can own it, who's the beneficiary, those types of things. So how does insurable interest fall into this once we're talking about an existing policy and this type of significant change?
Yeah, exactly. And I think what you're referencing is stolen. I don't want to get too wonky, right? Mm-hmm. But stranger originated life insurance is illegal and should be illegal, right? For instance, like I like you, Eric, but you can't buy a life insurance policy on me because there's no insurable interest, right? I mean, I like you, you like me, we're good, but we're not business partners. There's no insurable interest. But that's not what we're talking about here. What we're talking about here is when the policies that we sell were issued, there is insurable interest. There was insurable interest because the beneficiary is the business partner, the trust, the kids, the spouse, right? There's insurable interest there. So that's fine. All we're doing is transferring ownership to another party, thanks to Grigsby versus Russell.
Gotcha. Excellent. And then when you're thinking about what types of policies, so obviously, that's one of the confusing parts of life insurance is, you got term policies, you got universal life, whole life, variable universal, you got all these different types of names. So in general, what are the typical types of policies that might qualify, or how do you determine whether my policy has value from this standpoint?
The good news is any type of policy has the opportunity to be sold. Any type, doesn't matter. Even group life. So that's easy. Now, in terms of what qualifies or how it qualifies, let me backstory that just a second. So let's take a look at how the investors look at it, because that's the easiest way to explain what qualifies and doesn't qualify. The investors are looking for clients with, bluntly, 10 to 15 years of life expectancy or less. So if I'm 30 years old, and clearly I'm not, but I am in my head, I'm running marathons, this is not going to be the right solution. Typically, we're working with seniors, doesn't have to be. And in our world, we're opposite regular insurance. So the shorter someone's life expectancy is, the more money buyers are willing to pay for a policy, because bluntly, they believe they're going to be getting their benefit sooner. So 10 to 15 years of life expectancy or less. The older I am, I can be pretty healthy, right? 75, 80, 85, pretty healthy. The younger I am, we have clients in their 50s, the more significant the health issues I need to have to kind of fit in that window the buyers are looking for.
Got it. And that's what I was going to ask. So I'm glad you brought that up as far as that age component to it, and understanding, if there was the unfortunate situation of a terminal illness, that changes the circumstances versus somebody who's really healthy and knowing that, I got 40 years to live. There's not going to be a whole lot of interest in that particular policy, I would expect.
Yeah. Yes, correct.
So in general terms, I know that, is there any rule of thumb, high level guidance you could share around how much of a policy's value someone might potentially receive through a life settlement? I know every situation is different, but just maybe even just a framework of what the expectations might be.
That's a tough one. So let me start with, we as in the market is looking for policies of about $100,000 of face value or death benefit or higher, around, right? Nothing is in stone. Mm-hmm. So there's that. It's almost impossible to give that answer, Eric, but I am going to give you an answer.
Perfect.
That's helpful, right? It truly depends upon every single client, because every client is different from their life expectancy and their policies are different. I mean, even if you have two universal life policies that are $150,000, they've been funded different. Their cost of insurance is different. Everything is different. But what I can tell you is this: on average, last year, we generated 6.5 times cash surrender value for a client's policy. So once again, everyone's different. Sometimes we get 2 times, sometimes literally 150 times. But on average last year, about 6.5 times cash surrender value.
Perfect. And I know, unfortunately, when it comes to insurance related products, there's always the potential for predatory sales practices, whether it's an advertisement or just getting connected to the wrong people. What are some red flags that you think people should be aware of as they start to explore this as a possible option? Or more importantly, what can they do to protect themselves in case and to make sure they are working with the right people?
In terms of our market, I would do a couple of different things. First of all, as you said, research. Have conversations with people, and your instinct will know if this is something that it feels comfortable or not. If someone's trying to pressure you into selling your policy, hang up. Because I'm not here to talk anybody other life insurance policy, right? All I'm here to say is, if you're going to lapse it, right? People have had conversations with their financial advisors like you, and they've decided, the two of you together have decided it doesn't make sense to keep this policy anymore. We're just here to get them more money. So make sure people are licensed. That's important. Ask them for their license number. If you're getting high pressure sales, hang up, because that should not be the case. It's a really big deal that people are comfortable with making this decision. and as well as make sure people answer all of your questions. People should get all the information they want and that they need to be comfortable with the process.
Hey everyone, it's Eric. Hope you're enjoying today's episode. I want to take just a quick moment to share a resource I think you'll find valuable. Have you ever found yourself asking, how much can I put into an IRA this year? Or how much can I earn before my Social Security gets reduced? Those are the kinds of questions that come up all the time, and the answers change often more than you think. That's why we created a free 2-page tax and retirement planning cheat sheet, updated for 2026, with the key tax, Social Security, and retirement numbers all in one place. You can download it right now at the simplyretirementpodcast.com/retirement cheat sheet. It's a simple reference you can keep handy whenever questions come up. Now, back to the episode. Are there any specific licenses, certifications, even organizations or associations that people should be aware of as they start to explore somebody like yourself that might be able to help them?
Yes. Every state has a license called either a life settlement broker license or a viatical settlement broker license. First of all, some states it's just a registration. That doesn't happen too often, but some states like Texas, that's the case. But for the most part, there's an additional add-on onto a life insurance license. And yes, there is an association. It's called the Life Insurance Settlements Association, lisa.org. I love that their acronym is my name. Worked out beautifully, but it's right. Lisa.org. And like I said, check out people's websites and people will know, are you comfortable, working with this person? And also lastly, Eric, make sure you know whose side they're on. Because this is not a commercial. I'm just saying, make sure you know whose side they're on, because there are brokers like me who represent clients. Our job is to get the most amount of money for a client's policy we can. But there's also direct buyers that do not have a fiduciary duty to clients. They're trying to get policies as inexpensively as possible. No disrespect to them at all. We work with them, of course, but their motivations are different. So make sure you know.
Well, I think it's from what we shared at the very beginning that you work with financial professionals, insurance people. So having that level of connection already in place, that level of trust, I think could be huge when you're exploring such an important topic like this. One of the things I want to find out, in our practice, we spend a lot of time talking about taxes, tax planning. How do we reduce your lifetime tax liability? I think that would be something that would be very helpful for the audience as well. So when you're evaluating life insurance settlements, what are some of the key tax considerations people should be aware of? And why is it so important to have that tax conversation as part of this process?
Well, no one wants any surprises, right? And I'm going to preface
not with taxes.
Well, exactly. Yeah, because then it's too late. I'm going to preface it by saying, clearly, I'm not a tax professional or CPA, and people should consult their own tax professionals, but I'm going to answer your question. This acts like an asset sale. In other words, the premiums that people have put into the policy from the beginning of the policy are a basis. And so if the settlement money is underneath that basis, and many times it is, because clients have funded policies for 20 or 30 years, right? Many times the settlement money is underneath that basis. If that's the case, it should not be taxed. Over that basis, typically, I use typically a lot, typically is long-term capital gains. Now, not trying to get too wonky, but there can be some policies, if there's a gain inside the policy, right? There's a little cash value gain, that little corridor could be ordinary income. Still true for our market, right? That's normal life insurance taxation if someone would even surrender the policy. But typically, right up to the basis, no tax over that long-term capital gains.
Well, ultimately, what I would take from what you just said is make sure you coordinate with your team. Life insurance settlement specialist, the financial advisor, your tax advisor, to make sure you understand exactly what those implications are going to be before pulling that final trigger.
Absolutely. And the good news is there's a couple fold. One is there's no obligation. So we have clients that say, Lisa, I want to know what my policy, can go for. And then once we know what that final number is, right? Once again, we drive up those numbers. But once we know what that final offer is, the highest offer is, they do say, look, I need to talk to my tax professional. I said, you do that, because just to make sure all of the ramifications, if you will, of selling the policy. Now, to be transparent, Eric, I literally have never had a client not sell a policy due to taxes, because they're going to walk away from this and we're getting them more money. So why wouldn't you? But you're right. It is an important conversation to have.
And I would put you in the shoes of what a potential client might look like in our city, in a conversation I might be having. A lot of our clients are women who, again, finding themselves at the other side of divorce or being widowed. So let's say it's a woman who's recently lost her husband. Maybe she's in her late 60s, early 70s. Both had life insurance, but now as a surviving spouse, she still has her own policy in place. What are two or three key issues you think she should consider when evaluating whether a life insurance settlement might make sense in her situation? And also, what role would you play in helping her evaluate those options?
As I mentioned before, I work with a lot of advisors. And so my role is not to advise if this is the right scenario or not, right? That's just not what I'm here to do. What I am here to do is say, it makes sense to market the policy. Let's see what we get for the policy from an offer perspective. And then you, with your professionals, can make the determination if it makes sense for you and your family. But because at the end of the day, the clients that we're ultimately talking to with their advisors, they've already come to the decision that they don't want the policy, because prior to, you've already had the conversation. Do you have another beneficiary you want to leave it to? How about a nonprofit? Do the kids want to pay for the policy, or the beneficiaries want to pay for the policy if it's become too expensive? Or maybe reduce the death benefit makes sense, right? All those conversations have already taken place, so that by the time we're having a conversation, we're at the last stop on the bus line, Eric. We are the solution when the decision's made. I'm going to lapse and I'm going to surrender it. I'm not going to keep it anymore.
Well, I think that's hugely valuable. So again, thinking from my perspective as a financial advisor, number one, I need to know that this is a possibility. This is an option other than just letting the policy lapse or just surrendering the policy, whatever the case might be. How could we potentially more effectively utilize this asset, as you've described it, in a way that could help me with other areas of retirement planning? So just touch on that if you would. Is there any, just to be clear, is there any restriction on how the money gets used or anything that our audience should be aware of?
Good question. The answer is no restrictions. So asset sale, just like selling a car or a house, no restrictions. They can use the money for anything they want. And real quickly, and I haven't mentioned this before, we sell term policies all the time. I think you asked earlier kind of what our volume looks like. Universal life policies are our number one seller only because we see them implode all the time. But term policies are very close number two. And it's a great way to get clients money when they're literally going to walk away with zero.
Excellent. We talk about how home equity being such a huge part of the illiquid assets in a retirement plan. Does that mean, okay, we got to sell the house or we got to take out a home equity loan? There's some similar concepts. You already talked about the comparison between what you do in real estate. And to me, that's also another similarity, and say, okay, we just got to examine every strategy, especially we know people are living longer. We've got all the healthcare challenges that are facing us. This is just simply one more tool that should be in the advisor's toolbox specifically to say, hey, have you thought about this? Let's look at reaching out to somebody like Lisa to say, is this a viable strategy in your particular case?
That's exactly right. And you raised a very interesting point, because we see this sometimes where people are looking for ways to fund long-term care needs, because life happens, right? Especially unexpectedly. And maybe my spouse needs assisted living or memory care or home care. Selling a life insurance policy can be a good way to repurpose this asset to help them be more comfortable while they're here.
Perfect. And so for someone listening, and you kind of already answered this, so tell me, correct me if I'm saying this incorrectly, but so if somebody's listening and they want to learn more about this strategy, where there might be a good fit, what's the first step? Is that first step to reach out to their financial advisor? Do people reach out to you directly? So is the end user or the potential seller, would they reach out to you directly, or would they first reach out to their financial advisor or their tax person first?
I would reach out to me first. Here's why. A lot of financial advisors, Eric, and that's why I'm so grateful for you helping us to raise visibility for this, because many financial advisors either don't know about it, or their broker dealer precludes them from talking about it, and they don't know. So real quickly, I'm going to digress for a moment. Remember I told you the 2.5 million seniors that get rid of their policies every year? Last year, nationwide, 2,699 sold. It's a really, really big gap. And a lot of it is advisors, both insurance and financial, either don't know about it, aren't comfortable with it, have misperceptions about it, and they're not talking to their clients. So the answer to your question is, I would invite clients to talk to me. I'm not trying to cut out their financial advisors. It's super important to have those conversations, but let's talk about the policy. And then, yes, please talk to your financial advisor as well. But I would talk to both of us.
Well, I expect one of the most valuable things you could add is, hey, what questions? My financial advisor's never brought this up. What questions should I ask him or her in order to determine whether this is an appropriate strategy for me? To me, that's always one of the key things I talk about is you may not know the answer, but you got to ask the right questions.
Yeah, that's exactly right. And visibility is key, and education is key. And that is my passion. So I'm grateful.
Well, perfect. So that's a great transition. So how would people reach out to you? How can people get in contact with you? Your website, social, whatever you'd like to share.
I am on LinkedIn. And you see my last name. So my website's Rehburg Life Settlements with an S, .com. My phone number is 714 area code 349-7981. And my email is really easy, Lisa at RehburgLifeSettlements.com.
That is perfect. So we'll be sure to share all the links to Lisa's website, resources that she shared on today in our show notes. Lisa, thank you so much for joining. This has been a really important and definitely an eye-opening conversation for me. I hope so for the audience as well. If this strategy resonates with you and you've been trying to determine what the best thing to do with that old life insurance policy might be, I definitely encourage you to reach out to a professional like Lisa to learn more. What I've learned for myself is that this isn't about a quick decision. It's just about understanding your options before making a permanent decision. And this is one of those areas where having the right information at the right time can make a huge difference in your next steps forward. Again, thank you, Lisa, for joining me. Thank you to our listeners for tuning in. That is it for today's episode. And once again, for all the links and resources mentioned, you can visit the simplyretirementpodcast.com. Until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.